We are back. David Burrows is taking your questions today. Jarvis in Ontario has sent us an email. Jarvis, thank you very much. Facebook has moved up a bit. What do you think of its plans when it comes to cryptocurrency and the outlook for the stock?
Right. So let's just talk about the stock for a moment. Obviously, they enjoy a dominant position in social media. Instagram is a wild success. Their market share in digital advertising very high and growing. All of those things are favorable. We're headed into an election year. And the reality is when they start to talk things like antitrust and regulation, that can put a drag on a company.
And plus political manipulation of Facebook.
Right.
Yeah.
So I think that the news flow is not going to be overly friendly. I think it is going to make it difficult. I think that their attempted entry into this cryptocurrency space is interesting for a couple of reasons. They have this giant user base. When you look at businesses like Western Union, who do global remittances, people transferring money around the world, and they charge 7 to 10% for low-income people to send money between lesser developed countries. There's an enormous opportunity for Facebook. That's like a $600 billion market.
To disrupt that market.
To disrupt that market. Yeah. So it's not a traditional cryptocurrency.
No, but it's going to be based on real currencies.
It'll be based on real currencies. And they have real partners and real endpoints. So I think they do have a really great opportunity. It's going to be a political challenge for them to get this off the ground. But it's, I think, very, very interesting.
The banks obviously are going to have some reservations. They'll try to, if it gets traction, they'll lobby against it, presumably.
I mean, listen, for a company like Western Union, it could be unbelievably disruptive. So, look, the internet's been great at disintermediating and taking industries that are inefficient and forcing efficiency. So that could be really good for consumers. I think that Facebook is a great company. I think that likely over time it does well. You just have to be prepared for the fact that there's going to be difficult news flow over the next year, and that's probably going to be a challenge.
Paul in Red Deer, Alberta, go ahead, and thanks for calling.
Yeah, thanks so much. I was going to ask, please, David, about TELUS. I've held the stock for quite a while. It had a nice little move up above $50 here earlier this month, and then it's backed off a little bit. I think it's industry with Rogers and increased data availability planned. It's just a competitive environment, so to speak. In any event, just wondering what your thoughts are on this stock going forward.
Sure.
Thank you.
Thanks a million.
So, Paul, look, this has been a dividend play for years. They've done a really great job of growing their dividend over time. You know, you're picking up close to a 5% yield. You know, I said off the top that the defensive sectors are very expensive relative to history, and that's people positioning for what their concerns are, maybe economic slowdown. I think that as a group, telecom has that risk built into it. It's not an inexpensive group. My personal view is I prefer to focus on things that have really good dividend growth going forward, because if we do see a higher low in yields than we saw sort of in 2016, you know, it could get difficult just for the big dividend payers. But look, TELUS is, for what it is, it's not going to be a market-leading stock, I don't think, over the next 3 years. But its total return should be decent. You're going to get your dividend yield. You're going to get some dividend growth. And you just might not get that much capital growth.
Okay. Paul, thanks for that question. Jerry in Vancouver, go ahead, please.
What's your view of tech resources going forward from the next 6 months or year, given the fact that it's diversified with base metal, oil, and coal? Would you be a buyer of tech right now, or would you stay away from it? And Andy, could you give us a street consensus, please?
I will have a look for that. Thanks very much for the question. Tech resources.
Okay, so I am not a resource bull typically, okay, but I am all about finding structural themes and revaluation. And groups go out of favor for extended periods of time, and then they go through a base building process, and then there's an opportunity. And I think that the base metals area is an area that has been unloved and underowned for a long time. In general, they peaked out around 2000, 2010, and they've been underperforming ever since. They underperformed while China was underperforming, really since 2014. The resource group put lows in 2015. They put in successively higher lows since then, in general.
Okay.
There was a higher low in 2017 for tech, a higher low in 2018, and a higher low in 2019. So I think this group is set up actually to do quite well. I mentioned off the top, if you were to put a chart up of Rio Tinto, a 5-year chart.
Okay. Yeah.
Now that's specifically iron ore.
Yeah.
But you would see that it's actually recently broken out of a 5-year sideways range.
Sure, and I think that's Rio on the New York Stock Exchange.
Yes, it is.
Okay.
And, you know, these companies have gone through, there's been consolidation in the industry. Companies have cut back on their spending. There's not been a lot of new capacity coming on. And when these things consolidate over a period of years and break out, as for instance Rio has just done, the technical targets are way higher. So unless we're headed into a real recession, which these charts are not pointing to,
and you don't think we are,
and I don't believe we are,
yeah.
then I would say the risk reward is very, very good because these stocks are cheap relative to history, and they, you know, for instance, the Rio and the BHP are well outperforming the market. Now, tech is not completely in that camp, but it should participate alongside. You know, they should earn about $3 a share this year. If you went back to 2009, they earned $2, so 50% higher at a much lower share price. I think it's quite attractive.
The street, I think, agrees. 20 buys, 3 holds. The average target about $40, and the stock just under 30 right now. Okay. Tech Resources, one to watch. Mark in Brampton, Ontario. Go ahead, please.
Good afternoon, gentlemen. I'd like to know what's going on with Enbridge. It's on its knees now it's been a while. Do you see anything positive happening within a couple of years? And what do you think of the dividend? Is that safe? Thank you very much.
Great.
Okay.
So look, $2.95 dividend. So obviously it's a high yielder, 6.5%, 6.4%. I think that the dividend is safe. I don't think you're likely to see much dividend growth in the near term. As I mentioned, you know, you have to pick your spots. Some of the energy infrastructure has been behaving quite well. Enbridge has behaved less well. You know, technically broke down a little while ago. This is a big dividend payer that people own for the yield. And I guess getting away from Enbridge just for a moment, I would try and focus on where we're going to get the best dividend growth going forward, and total return, share price appreciation, and dividend. The bond proxies are pretty well owned.
Right. When you say bond proxies, you mean yield stocks?
So when I say bond proxies, utilities, telcos, REITs, obviously not all REITs are the same. Some have much higher dividend growth than others or distribution growth than others. But the safety trade, people that have focused in the sectors that are not so economically sensitive, have paid quite high prices. And if yields at some point start to work their way higher, there's some reflation in the system. It gets hard for them to provide really good returns. So I just think the valuations are better in some of the economically sensitive groups, and there's a lot more upside.
A bit of news on Enbridge, that slugging match with Michigan over that old Line 5 pipeline. Michigan concerned about an underwater portion of it, got hit by an anchor. The Attorney General suing.
Yeah, and look, Enbridge are great operators. So again, for the dividend-seeking investor, this is going to be just fine. It's just not. You're not going to compare this over the next 5 years, I don't think, to the S&P and wind up ahead.
Okay. A bit of breaking news still on energy. Alberta has hired CIBC to help it market that crude by rail program that was set up by the previous Premier, Rachel Notley. The government saying the future of crude by rail is very bright and will continue to be without government interference. They say interference. So CIBC will help oversee the divestment of the sale of this to the private sector. We'll be back with David Burrows. He's President and Chief Investment Strategist at Barometer Capital Management. North American large caps are on the menu, 1-855-326-6266.